Welcome back to Market on Close. I'm Caroline Woods. We have about 12 minutes left in the trading day. It's time for the big picture. Let's welcome in a team member from Charles Schwab. That's Kevin Gordon, Senior Investment Strategist at Charles Schwab. Kevin, great to see you. Thanks so much for joining me.
Nice to see you.
All right, so Kevin, stocks off the highs, but still posting pretty impressive gains for today and higher now for the week. We already saw that round trip post-Liberation Day. S&P only down about 3% and change year to date now. Is this a market that can continue to climb higher? What do you think?
Yeah, I mean, I think from here it's probably more of a grind because when you look at, that huge whoosh down that you got to the April 8th lows and then the bounce back, I think a lot of that was trying to understand how to price, really the panic move associated with what was a really aggressive, proposal by the administration to put on, tariff rates for the world, quite literally. Now that you're seeing some of that walked back via some sort of delay, or today in the instance of the United Kingdom, you're starting to actually see some sort of framework towards, getting to some kind of coalition or some kind of agreement in terms of purchases, cross border. I wouldn't. I think it's probably a stretch to say it's some kind of really comprehensive, huge trade deal. Most importantly, because there's still not a material decrease or decline of the tariff rate that's been imposed on imports from the United Kingdom. So, to the extent that it's a framework for us not being, as hostile or having hostile relationships with our major trading partners, I think that's definitely a step in the right direction. But if you tie into it the fact that tariff rates haven't come down meaningfully for key areas of the world, I think that's probably going to be more of a sticking point, and probably why you have a little bit more of a grind higher, or maybe at best just a grind sideways as the market tries to digest it.
Well, and 10% tariffs are not nothing either. So even if those stick, what should we be thinking about in terms of the economic implications, but also the stock market implications there, given the fact that we have already seen quite a bit of a turnaround here?
Yeah, I mean, from here, I think if that sticks, and if you get some direction of travel, at least that is tariff rates coming down and moving lower, as long as you don't go through what we went through in early April, where you were seeing this massive volatility in terms of tariff rates shooting really high, but then moving around consistently almost every single day. If you have a direction of travel that is lower for rates, for actual tariff rates, I think that's a good thing, obviously, relative to a month ago. But it also lets us assess what the actual impact is going to be on the real economy from that. So from here, we can probably start to see in the next few weeks, hopefully, the actual hits to hard data and whether there is a material hit to the economy. And I would think that probably, the biggest report we'll get in terms of a fresh read on it is probably the May jobs report, because that's where you probably start to see, hits to the manufacturing sector, if there are any. And I would weave into that potential hits to the services sector, because tourism has declined, pretty significantly in the U.S. And so if that's going to have a material impact on the jobs market, it's going to show up most at leisure and hospitality, which is essentially the biggest services employer in the United States. So I think you're probably, going to at least start to get some hints of it in the near term. So far, so good. I think that's one of the reasons that, number one, the markets responded well today because of claims, but also because if you just take a step back and look at the past several weeks, I mean, the weakness in the soft data has not filtered over into the hard data.
Yeah, not yet. It seems like there's a lot of expectation that it is going to start to, though. But to your point about maybe a little bit too much focus on the goods deficit and not necessarily paying enough attention to the impact to the services side of things, what could that do to the idea of the possibility of a recession if we do start to see that hit?
Yeah, I mean, I think it raises the probability that, at least raises the baseline expectation that you could have one. And, it doesn't need to be, recession doesn't need to be some sort of catastrophic event. We've had recessions before that have been relatively mild in nature. 2001 comes to mind. Even the early 1990s comes to mind in terms of shorter in duration and really not as painful in terms of the drop in GDP. Of course, 2001 was associated with a really long bear market. So it's not always the case that just because you have a short and shallow recession that you have a short and shallow bear market. But I think that paying attention to services here is just as, if not more important than everything that's going on and that's discussed on the goods side, because you're right, a lot of the attention gets put on the goods deficit, and that's where the attention has been, especially for those in the White House. But I think that more importantly, not just because we've been able to run a services surplus for so many years for basically the rest of the world. But because services is the dominant employer in the country, I think that's really going to be an important point moving forward because to some extent, that's really not in the control of any of these trade deals that get negotiated. Services is going to be basically our services demand is going to be determined by others who use that, particularly around the world. So I think that's going to be an important sticking point. And if there is kind of this slower grind lower in the economy, services, eventually probably taking it, a little bit harder. I think that's going to probably depress economic growth and overall economic potential if that ultimately materializes. It's probably going to be a little bit of a slower burn. I don't think it's something that just happens all at once and you see it in 1 month. But that's why I think some of the services data, particularly from ISM, which looks okay right now, I think that becomes really important moving forward.
Okay, we'll certainly pay attention to that. Also want to get your sense of what investor sentiment is looking like right now.
Yeah, so sentiment, really the big washout over the past month has been on the attitudinal side. So any survey-based data that's been asking investors, how do you feel about the market? How are you feeling about investing in stocks moving forward? AAII has been really the kind of taking the center stage for that. And clearly, you went through the big whoosh down, you got through that washout status. It started to filter over a little bit into the behavioral side of things. So AAII has, in addition to the weekly bull bear survey they throw out, they do a monthly one that they put out to investors actually tracking their allocations. And actually through April, you did start to see equity allocations dip a little bit. So there was, definitely not anything close to capitulation, but there was, a little bit more tremors and fear that started to creep into actual positioning. So I think it's, created certainly a sentiment environment that's been favorable for the bounce that we've seen. Although now that it's been so fast and so furious and so strong, you're probably going to see the sentiment data catch back up to then, and we kind of get into that sort of medium middle territory again. So I think that it's been a support so far. But if you're kind of taking a step back and looking over the long term, from a behavioral side of things, household equity exposure is still right near its all-time high. Specific allocations to equities when you look at portfolios are right near an all-time high. So there hasn't been too much of an adjustment there, which just tells me that if you do go through another really turbulent period from a tariff standpoint or from a policy standpoint, there would be still, a lot more downward pressure, probably because of the exposure that a lot of investors still have.
Okay, so finally, as senior investment strategist, tell us what's the best investment strategy right now, given everything you've laid out.
Well, I'm always we're always in favor of saying staying invested is the best strategy because it is, as long as you're, paying attention to what your allocations are and what your time horizon and risk tolerance are. And I would say that, in this particular period, especially what we've gone through, both to the downside, but also to the upside over the past month, that has been a really important thing in terms of assessing your risk tolerance and where you stand, particularly in the equity universe, because that's what I cover. But I think really understanding where you want to be exposed and just knowing what you can stomach from a volatility standpoint, that's really important, especially when you go through these massive swings to the upside and the downside. If you're getting a little bit more granular, at the sector level, because of these wild swings we've seen, not just at the index level, but in terms of sector leadership, and really the lack of clarity that a lot of us have in terms of figuring out what sectors are going to do best in this environment, we've neutralized our sector performance and our sector rating. So everything has been taken to market perform. We're still focusing on things a lot more from a factor side of things. So looking at companies or industries that are have high profitability, have strong margins, have strong margin guidance if they're giving guidance at all. All of those from a profitability standpoint have become really important. Especially for differentiating between companies or industries that are at the center of this tariff turmoil versus those that are a little bit more insulated.
Okay, we'll leave it there. Kevin Gordon, Senior Investment Strategist, Charles Schwab. Always love when you're on. Thanks so much.